US markets are firmer, but in a holding pattern just hours before Donald Trump's Independence Day tariff news. Australia's housing market is picking up, while building approvals in New Zealand are sluggish, and inflation unexpectedly lifts in South Korea in the middle of rate cuts. That's coming up in our 5 Things in 5 Minutes on Thursday, April the 3rd. And then, in today's bonus deep dive interview, ANZ FX analyst Felix outlines ANZ Research's work developing a new method to detect foreign exchange trading signals.
Looking at the risk factor bucket, that's that Aussie and Kiwi being the canaries in the coal mine.
But first, in 5 and 5 with ANZ, US markets wobbled overnight, and as of 4 a.m. Sydney Melbourne time, the S&P 500 is up 1%, and the US 10-year yield is up 6 basis points at 4.22%. All eyes, though, are on tariff news expected at 7 a.m. Sydney Melbourne time from Donald Trump in the Rose Garden at the White House. ANZ head of G3 Economics Brian Martin says markets traded cautiously before the big news, although US ADT private sector payrolls figures were better than expected, ahead of tomorrow night's non-farm payrolls figures for the US economy.
We think, though, that employment is the lagging indicator, and whilst the breadth of tariffs has not yet been introduced, firms therefore haven't been able to make decisions, and we know it is going to take time for federal worker redundancies to show up in the labour market data. So we're not expecting the labour market numbers to indicate a material slowing in economic activity just yet. However, that is something that could materialise during the second quarter of this year if large tariffs are confirmed.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.4%. The Aussie dollar up 0.9% at 63.01 US cents. The New Zealand dollar up 1% as well at 57.4 US cents. Gold up another 0.7% at $3,170 an ounce, and crude oil, as measured by the West Texas Intermediate futures, up 0.7% at $71.72 US a barrel. Number 2, Australia's housing market is picking up, with capital city house prices rising 0.4% in March after a 0.3% rise in February. ANZ economist Maddie Dunk says there looks to have been only a shallow housing downturn in the months prior.
We've seen pretty broad-based improvements in housing prices, so they're up across all of the capital cities except for Hobart, looking pretty strong in Darwin in particular. Now, Darwin can be a bit of a bumpy one, but if we look at prices just over 2025, they're up 2.8%. Now, they're of course rising from a much smaller base compared to some of those other capital cities, but that has been the strongest market over the last couple of months. We're also continuing to see reasonable strength in Adelaide and Brisbane.
Number 3, Australia's building approval numbers are also feeding into the trend. While approvals fell 0.3% in February, that followed an upwardly revised 6.9% lift in January.
The main picture that we're seeing on the building approval side is that there does continue to be this movement upwards. So if you look at building approvals, they're up 25.7% over the last year. And in particular, private unit approvals are up 73% over the last year. So really robust results there. And we are continuing to see signs that capacity constraints are easing in the construction sector. We also know that rates, of course, went down in February. So that's helping a little bit with funding costs, and we do expect that overall you are going to see that continual improvement in building approvals over the coming months.
Number 4. Meanwhile, in New Zealand, building consents rose 0.7% in February, following a 2.6% lift in January. ANZ economist Henry Russell says it's not yet clear that a recovery is underway, particularly as annual consents are now down nearly 7.5%.
The downtrend in consents has stabilised, but we're not yet seeing a meaningful pickup yet. And that isn't necessarily inconsistent with our forecast. We do expect to see momentum build into the second half of the year. But nonetheless, it does highlight that the construction sector is likely to be slower to turn than some of the other industries in the economy. And that in part reflects the impacts of restrictive interest rate settings over the past year that have eroded the pipeline of work.
Number 5. Annual inflation in South Korea unexpectedly rose to 2.1% in March, with core inflation rising to 1.9%, near the central bank's 2% target. ANZ economist Crystal Tan says inflation looks like it will remain sticky around its current level.
On one hand, there is upward pressure from the weak won, so that's making imports more expensive. But at the same time, the upside is going to be capped by modest domestic demand and also still benign global oil prices. So overall, today's inflation print, coupled with a weak won, they don't support the case for a back-to-back cut by the BOK, but with growth risk still high, we do think policy rate reductions are a matter of time. So our base case is for 2 more 25 cuts this year.
Crystal tan there. Now, in today's bonus deep dive interview, ANZ FX analyst Felix explains why ANZ Research has developed a new method for detecting foreign exchange trading signals beyond the traditional carry, value, and momentum factors. He tells my colleague Alex Tarrant about including the more dynamic risk, haven, and growth factors.
Well, essentially, we want to look at how various currencies perform on a broad basis. So just sticking with the G10 currency space for the time being and just seeing, for instance, how is the Aussie performing, not just against the Kiwi and the Euro, but also against the dollar, the Swiss franc, the yen, and then looking at all these different, grouping all that into one sort of bucket. So the Aussie dollar sort of broader performance. And then from there, we're seeing, there's similarities between how the Aussie is performing on a relative basis with, say, the Kiwi or the yen or the Swiss franc and so on and so forth. And in that sense, we can sort of start to see how certain currencies can perform in similar ways on a broader sense. So, for example, the Aussie and the Kiwi typically or historically have largely performed in a very similar manner to each other on the broader suite of G10 currencies. Usually when we see the Aussie US fall, we also see the Kiwi US fall, and we see Aussie Kiwi fall as well in a very similar way against the Euro and the sterling as well, at least in a historical sense. So we would see Aussie and Kiwi therefore be grouped together into one part of the factor model, let's say, in terms of assessing performance. That's essentially what we've done in terms of constructing all these new factors. But I suppose the bottom line, though, in terms of the results that we found is that there are generally 3 FX factors that we found out of the G10. So on one hand, we have, I've already given it away, but we have the Aussie and Kiwi typically being together. We find that, unsurprisingly, that they're quite sensitive to things like changes in risk sentiment. So when we see, for instance, announcements of tariffs or risks of the economic outlook, we obviously see Aussie and Kiwi underperform, at least historically. On the other side of the spectrum, though, we have the more haven currencies or safe haven currencies. And again, there's no surprises as to who these currencies are. It's usually Japanese yen. When we see turbulence in global markets, we do typically see the yen do well on a relative basis. The Swiss franc is also in that bucket too, and the US dollar typically hangs out there as well. So that's those 3. Other end of the spectrum. And then sort of sitting there in the middle, we have more growth-orientated currencies. So historically, currencies that have done relatively well in environments of robust economic growth. And so that would include things like the euro, the sterling, basically the sort of European area currencies as well.
How would you apply this into a trading strategy, potentially? Is it more like looking at what the backdrop is, the economic backdrop is, whether that's a growth or a risk or a haven sort of backdrop, and then determining how to tweak your portfolio?
Well, the backdrop is obviously quite an important feature of this. I guess in terms of thinking about what the implications are from some of these different buckets that I've discussed, this risk, growth and haven buckets out of the G10 currency space, I think some of the results aren't too surprising. I mentioned looking at, say, the risk factor bucket over on one hand. So again, that's that Aussie and Kiwi being the canaries in the coal mine, if you will, in terms of being very sensitive to those changes in risk sentiment, to shifts, say, in global equity markets, to any sort of major shift there maybe in the commodity space too. So when we think about potential environments where Aussie and Kiwi haven't done very well historically, it has been when there's been a large sort of calamity in the global space. Obviously, the GFC comes to mind, the onset of the COVID pandemic in early 2020 as well being another prime feature there too. And then thinking about as well the other buckets, so the growth and the haven bucket as well, we can sort of get a sense of when and where these currencies may or may not do so well. So again, contrasting that maybe is looking at the haven sort of factor there. We can see, yen and the Swiss, there's haven demand when the world isn't in a very good place. So again, the GFC and COVID do spring to mind in that sense too.
Felix Ryan. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, April the 3rd. Catch you tomorrow with how markets reacted to the US tariff news, expected at around 7 o'clock Sydney, Melbourne time. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.